Good afternoon. This is Dale with the Snyder Group at Keller Williams Realty here in fabulous Las Vegas, Nevada. The topic of discussion today is going to be going over the Debt Forgiveness Act that was put in place in 2007 by George Bush, extended by the Obama administration, set to expire at the end of this year in 2012. Let me preface this video by, I am a licensed real estate agent, not a CPA or a real estate attorney. The information I'm going over with you today is going to be information I've gathered from talking with our entrusted CPA and other colleagues in the industry. So let's jump right in. I want to start with explaining what the tax liability means in the sense of a loan modification, foreclosure, or a short sale. So basically, if you are, we'll just use the short sale example. This will apply the same to foreclosure and loan modification. You choose to short sale your property. When that sells, let's say that you owe $300,000 on it and it sells for $150,000. That means that the $150,000 of difference that the bank is losing is potentially taxable by the IRS. The IRS sees that as an income since you're not repaying the debt. So what was instated with this bill was that if it was your primary residence and if you did any refinances and you used that money towards the upgrading of the home, then you would be exempt from having to pay tax on that $150,000. Well, that bill is set to expire at the end of the year. I'm going to go into a couple ways that you can still avoid paying this tax even if this bill expires. So the good news here is that the Senate Finance Committee approved through the bipartisan bill August 2nd to extend this Forgiveness Act through the end of 2013. This still needs to make it through the Senate and get signed off on, but from my understanding, it is going to get extended through 2013. So some of you may be aware of this already. Some short sales can take up to a year. So if you're contemplating doing this next year, I would get the ball started after the holidays at the latest, because it can take a year to do a short sale. Most of the banks are being very proactive and working with a good short sale team. You can get them done in 2 to 4 months, but it still could take up to a year. Let's move into the ways you could still potentially avoid it. Let's say for some reason this doesn't make it through the Senate and they don't extend it. Once again, you'll want to talk to your CPA, and we do have an entrusted one that can give you a free consultation if you'd like. If you're insolvent, meaning that your debts are more than what you have in assets, you can avoid paying this tax in itself just by being insolvent. Bankruptcies, you can still get out of this tax through bankruptcies. I'm not going to go into detail on that because I'm not a bankruptcy attorney. And then investment loss. This one's very important. We've done a lot of short sales in the last few years for investors that have never made a profit on the property. They were at a loss the entire time they owned it. So the way you can basically, it's a wash. When you do your taxes with your CPA, you end up not having to pay tax. So even if this does not get extended, I wouldn't rule out short sales or modifications, because there still are ways around it. So I would encourage you to reach out to me. We can advise you, we can point you in the right direction with a CPA or a bankruptcy attorney if needed. So you can also find out more information on our website at dalesnyder.net, our YouTube channel at Dale Snyder 1. And once again, it's Dale Snyder with the Snyder Group at Keller Williams Realty here in Las Vegas, Nevada. We've got a great short sale team put together, attorneys, CPAs that can help consult you, because the first step is to get valuable information so you can make the most informed, educated decision, right? I hope you're having a great, fantastic holiday season, and have a great day.